for those people that come in late or aren't able to make it at all, this is, this recording will go out so people can go back and watch the beginning. So welcome. I'm so excited to be putting this webinar on and joined by my friend Deva. We're going to be talking about some year-end tax planning strategies for people that work in the tech industry. We have a lot of information, so it's going to be pretty packed. We did get a bunch of questions ahead of time, and we'll hopefully leave something like 10 minutes at the end for Q&A. Feel free to drop additional questions in the chat, and we'll just do our best to get to questions as we are able. And with that being said, let's go and do some quick intros. So my name is Danica Waddell. I am the founder and president of Xena Financial Planning. So I'm based in Seattle. Our firm is virtual, so we work with clients all over the place and primarily work with people in the tech industry. So not every single person that we work with is in tech, but the vast majority are. And Deva, I would love for you to introduce yourself.
Yeah, I'm Deva Hetrick, and I'm the co-founder of Joseph and Hetrick. We're a tax prep and advisory firm with the same niche as Danica. So most of our clients have some form of equity compensation, stock awards, or stock options, or at least one partner in the couple, if they're coupled, is in this situation. So we like to, in addition to doing tax returns for you, meet with you a few times throughout the year and do some planning and strategy around your equity comp. Also, I'm a mother-daughter co-founder, so we have an intergenerational kind of nice balance going on.
Awesome. Before I go any further, I just want to say that there's going to be a lot of really specific kind of strategies that we mention, and many of them we're going to say something like, don't do this on your own. So some of these strategies can get really complicated and it's really easy to mess them up. And so we just want to be really clear about that. We're mentioning some of these things so that you know they exist. And so you can identify, hey, that seems like it might apply for my situation. And then you can actually go get a professional to help you navigate the actual mechanics, because we don't want people to go out and do some of these things that it's very easy to go astray. So I just wanted to mention that right off the bat. And then, of course, huge disclaimer across the board that we're not giving specific tax advice or specific investment advice, anything like that. This is really for educational purposes only. Okay. So just a quick run through on the agenda. These are kind of the things we're going to cover. This is recorded. We're going to send the recording to everybody. But we're going to talk about maximizing retirement contributions, making sure that you're taking advantage of whatever tax deferred kind of options are available to you. Estimated tax payments is something Deva is really great with and is just a huge thing that a lot of people miss, and the penalties are big. So we just want people to be aware of the implications there. Charitable contributions have gotten a little bit more interesting in the last few years with the current tax law. And so we just want to, sort of talk about some things to keep in mind around charitable giving. Tax loss harvesting and capital gains is something that is definitely one of those things where we're going to say, work with a professional. And we also want to highlight that for Washington state folks, there's a special long-term capital gains tax that you should be aware of. So talk a little bit about that. For people who are taking a year off or were laid off or whatever, for some reason have a lower income year, there's a few things to think about that might be, it's a good time to take advantage of being in a lower tax bracket. So we'll identify some of those. We'll talk a little bit about it, exercising incentive stock options, also known as ISOs, before the year ends and kind of triggering alternative minimum tax. We're not going to go real far in the weeds on that one. It's super complicated, but just mentioning that it might be something to consider. And then just a bunch of miscellaneous considerations like wash sales, the end of Tax Cuts and Jobs Act, and other fun stuff like that. Okay, so first and foremost, this seems like pretty kind of table stakes in the sense of like most of our clients are probably doing this already, but every once in a while people kind of, they forget to change their limits or their contribution, and they're actually not maxing out their 401k. So it's just a good time to double check, your pay stub and see, have you hit the maximum for this year, or are you going to by December 31st? If by some chance you're not, you've still got hopefully 2 or 3 paychecks maybe to make up the difference. So we put on the limits for 2023 there, and then in parentheses is the 2024 limit. So if you're checking, you might as well also say like, hey, I know what it's going to be for next year. Might need to increase the percentage or the amount per paycheck just a little bit to get to the 2024 limit. So it's also a good time to potentially change your contribution so that you know you're going to max it out next year. Total, I'm not really going to talk about total 401k contributions unless somebody has a specific question, but that includes if you're doing after tax mega backdoor 401k, that's the limit there. For IRA and Roth IRA contributions, there are income limits for these. You hopefully already know that, but if you're eligible to make IRA contributions, deductible IRA contributions or Roth IRA contributions, make those before the end of the year. You have until April to do it. Sometimes people will wait till the end of the year to see if they're under the income limits or something like that. But you have a little bit of time to make IRA contributions. Deva, did you want to say anything about spousal?
Just that, those are a lot of the time here, we're talking about IRA contributions that aren't going to be deductible. Like Danica said, there's an income limitation, but you can make a contribution for a spouse that doesn't have income or isn't working if you are working and have income yourself. So in that case, if it's not deductible now, it'll at least the growth will be deferred until retirement and they can be building up a retirement account as well. And then on the bullet point 1 up, I just want to add, she threw out mega backdoor Roth. If any of you have heard people talking about a mega backdoor Roth at your company, you are able to just get so much money into this after tax bucket that's going to grow tax free all the way till retirement. And so just even checking if your employer has that or if it's available within your 401k plan, or talking to someone like me or Danica to see if that's available to you is just an amazing benefit.
Yeah, if you have the option to do mega backdoor, it is a pretty great option. I know Amazon, Microsoft, Meta,
Apple, Airbnb, Google, a lot of the bigger companies.
A lot of the big ones. It's become much more popular in recent years. But if you have the option, mega backdoor is pretty great. And then HSA contributions. So again, we just have the limits on there. And you're probably, if you're not in open enrollment, maybe you're about to be or you just finished. But again, a good time, every year the limits go up to make sure that, you're taking full advantage of the tax deferred opportunities there.
Yeah, and you can on the HSA, when we're working on your tax return together, or you're working on your own tax return, go back and retroactively make a final contribution for the prior year all the way till April. Just you can do that online or call your HSA bank.
Yeah, awesome. Okay, so estimated quarterly payments. The first thing here is just to know when the quarterly payments are due. So it's a little bit wonky because it's not exactly 3 months apart. The sort of September to January is a little bit of a different time frame. But those are the dates that the quarterly payments are due. If you're getting any kind of self-employment income, or if you're, consulting, something like that, that's especially important because if you have, 6 figures of consulting income and you're not paying estimated taxes, you're definitely going to get dinged by penalties at the end of the year. Do you want to talk a little bit about how that works and what to be thinking about, Deva?
Yeah, so the due dates, like if you miss one, don't just say, oops, I missed it and wait till the next one. As soon as you make a payment, that helps limit the penalties. So you'll see the 3rd bullet point saying penalties can be as high as 8%. What that means is like, there's no red flag, like you're going to get audited, or there's no like bad mark on your record if you get a penalty for not making these. It's basically the penalty is just interest the IRS is charging you for not paying as you go along. So self-employment is a great reason why some people might be making these, but any income event that there's no withholding, like if you sell stock at a gain, if you just have really high dividend income, there's no withholding on that. Or if your spouse might be, if you're higher income and then your spouse is lower income, you've kind of dragged them along into this higher tax bracket. They might be under withheld on their salary and you might be making estimated payments to cover that. So there's a lot of reasons, and just kind of talk to your advisor. Should I be making one this year? Because each kind of month you're getting penalized again for what you should have paid earlier in the year.
Yeah. Selling a house would be another great example.
Yeah. Oh, and I want to say there is a couple safe harbor rules for this. I don't want to explain them, but there might be a way that you're safe from this penalty based on last year's income and this year. So ask someone about that.
Yep, there are some safe harbor limits. So if you're hitting safe harbor, it's not as big of a deal. But yeah, so and I just want to kind of re-emphasize that, you know, even if you missed a payment, or maybe you haven't made any quarterly payments yet, but you think that maybe you should, or you find out that you definitely should have, it still makes sense to do it today versus waiting till January 15th, because those penalties are accruing monthly. And then I think this is something that you suggested, Deva, but you can actually increase the withholding rate from your paycheck.
Yeah, this can limit penalties. Like you could even just increase your withholding rate very extremely for this last month of the year to get some money sent in. Or if you have something every year, like a rental property with profit or some side hustle income, and you don't want to fuss with estimated tax payments, you could just increase your salary withholding to kind of always be making up for that.
Awesome. Okay, so one of the things that happened with the Tax Cuts and Job Act, which is very hard to say, a few years ago, was the standard deductions increased by a lot. So many people that had previously been, you know, taking an itemized deduction are now using the standard deduction because it more or less doubled. And so what that means for charitable giving is that a lot of people aren't getting the advantage of it actually reducing their tax bill at all. So I put the standard deduction limits on here just for reference. So, you know, if you don't have enough like mortgage interest and property tax to exceed these thresholds, you might not be getting the benefit of making those charitable contributions. So a couple of things to think about there. One of the things that we recommend to clients is to consider bunching your charitable contributions into a single tax year. So instead of making $1,000 a year for 5 years, you might actually want to do $5,000 in a single year, because then you're actually going to exceed the standard deduction. You're going to be able to itemize, and you're going to get the full benefit from a tax perspective. So bunching your donations in a single tax year can make a lot of sense for people that are doing some charitable giving. The other thing to keep in mind is something like a donor advised fund. So a donor advised fund achieves the same basic concept, where if you put money into a donor advised fund, it's tax deductible in that year. So like the example I just gave, you could put $5,000 into a donor advised fund. It's fully deductible in that calendar year. And then you might actually distribute the funds over 5 or more years, and you don't ever have to report anything to the IRS in the future. So it's really, really easy and very kind of streamlined from that perspective. So if you're charitably inclined, a donor advised fund can also be a really useful vehicle. Any specific questions on that? Or Deva, do you want to talk about gifting stock versus cash?
Yeah. And just that I love donor advised funds for other reasons. Like they will track all of your contributions for you. So you're not having to like gather your receipts for us or for yourself while you're preparing your taxes. And Danica, you even pointed out the other day that the donations are anonymous, so that you're not getting 12 letters a year in the mail from that same organization asking for more. And okay, gifting stock is one of my favorite things to help people start doing, because it sounds sort of fancy. Like I've never donated stock. I don't even know how to do that. I'm just going to keep doing my monthly donations. But there's a double tax benefit when you give stock. And so you get the deduction of the full fair market value of the stock the day you donate it. And you also get to skip paying capital gains tax. So if you have stock that's gone up in value, or might be company stock where you work, if you're to sell that stock and then put the money in your checking account, and then later in the year write a check to the organization, you've had to pay tax when you sold that stock at a gain. Instead, you can just straight up donate the stock, skip the capital gains tax, get the full deduction. It's really nice.
Yeah, there are a ton of benefits of using a donor advised fund. I mean, there's also some downsides. There's, you know, just some like administrative hassle and maybe some additional fees and things like that. So it's not necessarily an obvious choice, but there, certainly from a tax perspective and from a simplicity perspective, I think, you know, having to track a single contribution to a donor advised fund versus pulling together 20 or 30 receipts at the end of the year to give to your tax preparer makes things a whole lot easier.
Yeah, and those two things don't have to be together like you can just straight up make a donation of a few shares of your company stock to an organization without opening the donor advised fund as well. So you can do either. Or
Yeah,
both.
one thing to mention about gifting stock is I think there are quite a few charities that might not be able to accept stock. So it's a little bit more limited, but you're right, it does have some extra tax benefits. Okay. RSU tax treatment, always fun. So we wanted to talk a little bit about RSU. So this, I mean, the stuff we've touched on thus far hasn't really been particularly geared to tech people. But RSUs are something that in many ways are relatively straightforward. And yet the number of times that I've had to explain this tax treatment to people that are getting RSUs is significant. So I thought it would be worth just at least briefly touching on how the tax, how RSUs are taxed. So if you get a job in tech and you are given a grant of RSUs, you'll get it on a certain date and it will vest over a period of time, probably going to be 4 years, give or take. When you are granted the shares, there's no tax implications. So you do not pay any taxes on the day of grant or anything like that. As those shares vest, they are fully taxable at your marginal tax rate. So if you have 50 shares vesting every quarter, every time those shares vest, that gets added to your income, just like your paycheck, just like your salary. It's taxed on Social Security, Medicare, federal income tax, and state tax if you live in a state with income tax. There are no capital gains tax due on the vest date. So that's just 100% ordinary income, whatever your tax bracket is. If you sell them right away, there's basically no tax implication beyond that. So it's already, the full value of what they were worth on the vest date is already part of your income. If you sell them 2 days later, probably the stock hasn't changed a whole lot. So there's very, very minimal tax implications if you sell right away. If you hold the shares for less than a year, so let's say you wait 6 months, they've gone up or down a little bit, but who knows which direction. You will owe short-term capital gains on whether the stock price has gone up or down. So I guess it'll be gain or a loss. And it'll just be based on whatever the share price was on the vest date. So, if it's gone up $5 a share, then you'll pay short-term capital gains rates on that gain. If it's gone down $5 a share, then you'd be able to take a loss. If you hold the shares for more than a year, now it's long-term capital gains, which depends on your income level, but could be, probably for most people on this call, something like 15%, maybe 20%. So it's probably going to be less than your actual tax bracket. And again, the cost basis is whatever the RSUs were worth on the vest date. So you'll pay, long-term capital gains based on whatever the stock price has done since then.
So yeah, just like to re-explain one point there, you don't have to wait a year after your RSUs vest to hold them. If you sell them right after they vest, they haven't gone up or down much, and then you get to just diversify or use the cash to help fund your mega backdoor Roth or whatever.
Exactly. So the thing that trips people up with the RSUs and taxes is that for the most part, the default withholding rate for vesting shares is 22%. And probably everybody on this call, I would guess, is in a higher tax bracket than 22%. So for most people, the RSUs, when they're vesting, the company is under withholding on taxes. I don't know. Do you want to talk about that?
Yeah, I think, a lot of my clients are maybe only in the 24% bracket. And so, okay, fine. You have 22% withholding. It's not off by much. But as soon as you're in the 32, 35, 37, this is a huge problem. There's a huge shortfall here. And so you can see below that, Danica saying we want to set aside the difference that's not being sent in on our behalf. Or if your company lets you increase your withholding rate specifically for bonus compensation. So this is different than like the Form W-4 you fill out. That's for your salary withholding. And remembering too that this applies to any bonuses you get. So RSU is a type of bonus comp, but also if you get a sign-on bonus at a new job, that's a big one because people will get a big sign-on bonus and it's way under withheld compared to either their top or average tax bracket or a performance bonus or commission. So any of those things happen to you, you get a nice bonus, kind of alarm bells go off that you probably don't have enough, and you want to make an estimated payment.
Mhm, mhm. Yeah, the easiest way to deal with this, in my opinion, is to just change the withholding rate on your RSUs. So if you can, not
If they
every
let
company
you,
allows
yeah.
this. Not every company allows you to do this, but if you can, increase it to, it doesn't have to be all the way to your tax bracket necessarily, but if you're in the 32 or 35% bracket, I would at least raise it to 30. If you're in the 37% bracket, you might want to go a little higher, but I mean, there's not an exact science here, but we're just trying to get as close as possible to, what your actual tax liability will be for the year. But if you're not able to increase your withholding rate, the alternative is to sell some RSUs, sell all your RSUs perhaps, but set aside whatever that difference is, maybe into a separate account so that when the tax bill comes in, the next April, there's your $15,000 or whatever the shortfall is, already set aside.
And another thing I want to say is about like related to this and quarterly estimated payments. You don't have to make those payments on those exact dates. You can make as many as you want. You can make one every week if you want. The IRS will accept it. And so a lot of people, just when the event happens, that's the cleanest point for them to make a payment. So, if you have shares vesting on March 1st, you can just log in and on March 2nd and make the estimated payment for the shortfall. You don't have to be rigid to those dates.
Mm-hmm. Yeah, I think that's actually a really great point, because for many people, it probably makes a lot more sense to make the payment when they're already going in and selling some shares or doing some other transaction. Okay. So I mean, the bigger idea here is really about creative strategies and creative approaches to think through if you have a lower income year. So I already talked about, some possibilities where that might happen, whether it's, a layoff or a sabbatical. But in those tax years, if you're going to be in the 12% tax bracket, for instance, that's a really great time to sort of take a step back and say, all right, what have I not been doing that might make sense to do in this lower tax year? So for instance, we have a client that, has an inherited IRA, has to be distributed within 10 years. That would be an ideal situation where, hey, this is a lower tax year, I'm going to take more of my distributions, or maybe the entire account distributed in a single tax year, as opposed to spreading it out over 10 years. So if that's something, that would, again, this is something you probably want to do with a professional, but if you have a lower tax year, that's an example of something that you might want to consider. Roth conversions would be another one. So if you have an IRA and you want to start converting it into Roth dollars, you can do that in a lower tax year. And then any kind of significant gain you have in stock, if you have a lot of capital gains, let's say you're sitting on, a whole bunch of your company stock and there's a lot of capital gains in there. If you have a low tax year, that's another opportunity to just sort of, use that, take advantage of being in a lower tax bracket and diversify out of your company stock. And then tax loss harvesting is, if you have losses in one part of your portfolio, you can use that, sell those, that holding, and maybe sell something else at a gain and try and net those things out. So again, this is something I probably wouldn't recommend that you necessarily try on your own, but if there's something that has a big loss and something else has a big gain, like that could be a good opportunity. So it doesn't have to happen in a low tax year. That can happen at any time. But tax loss harvesting is really just sort of identifying things that have a loss, things that have a gain, and trying to kind of net them out as much as possible. Anything you want to add, Deva?
Yeah, just like to flip that on its head, if you're having a high income year, if you're in the 37% tax bracket and you're not usually maybe making more contributions that year, because anytime you're contributing to your pre-tax retirement account or making a charitable contribution that's deductible, you're just saving in that top tax bracket. So if you contribute 10K to your 401k, you're saving, $3,700 in tax by making that contribution. So whereas in another year, if you're only in the 24% bracket, it's way lower. So yeah, just kind of like noting to yourself if you're having a much different income year than usual and talking to your advisor about the strategies around that.
Mm-hmm. Yeah, another example there would be like if you've been in the habit of making Roth 401k contributions and now you're in a really high tax year, you might want to switch to pre-tax.
Yeah, just have fun for a year and get the top tax savings. Yeah,
Yeah.
definitely.
Okay. Incentive stock options. So I don't know how many folks on the call receive incentive stock options. I definitely see RSUs a lot more often, but incentive stock options, I guess the first thing I wanted to call out, even though it's the third bullet, is there's a difference here between, publicly traded company like an Amazon and a privately traded company like Figma. So if you work for a private company and you have incentive stock options, exercising them is a much more risky proposition because you can't turn around and sell them. More than likely, there's not a market for them the same way there is for a publicly traded company. So I just want to be really clear. Anytime we're talking about incentive stock options for a private company, if you're doing anything at all, it's incredibly risky, right? So you're essentially taking a huge gamble with anything that you exercise, and the chances of you recouping your investment are probably on the smaller side. Everybody likes to think that their company is going to be the one that makes it big. But when you exercise stock options in a private company, be prepared to not ever see that money again.
Yeah, or similarly, if you're thinking about switching over to a private company position and the job offer includes ISOs, just knowing that that's not real money, it's potential hopeful dollars. So, making that consideration, making sure you're receiving a salary that's going to work for you as well.
Mhm. Yeah, there are a lot of different things that actually come into play when you're looking at working for a private company versus a public, but I would say you should definitely want to make sure that you're getting a good enough salary, because the stock options, may or may not ever be
Yeah.
worth anything.
Yeah, I love talking about ISOs. I could talk about them for days. It's what we do throughout the year planning with most of our clients. They're the most complicated kind of stock options. So boom, first bullet, we want to make sure there might be this potential for this extra tax called AMT. When you purchase the shares, you have to spend the money to buy the shares, and you also might create this other tax. It's more likely it's going to be created if there's a bigger difference between your exercise price, what you pay for the share, and what the fair market value of the share is today, and your income level that year really affects whether or not there's going to be AMT. So making an informed decision about exercising them with your tax pro or your financial advisor, and also just knowing there is a threshold. You can exercise some ISOs each year without paying AMT, and that's a nice kind of baby step, a way to start if you've never exercised any yet. Let's just do a little bit and not bump into that AMT.
Yeah, a lot of people are really scared of AMT. It's not necessarily that bad of a thing, but it's important to know, obviously, if that's the territory you're heading into. But one of the things I do with clients a lot at this time of year is we know exactly what your income is going to be for the year, pretty much, because we can calculate out kind of the last couple of paychecks. And so it's really easy for us to identify how many incentive stock options you could exercise without triggering AMT. And so for a lot of our clients, we're sort of trying to find that sweet spot of exercising just that many where they aren't triggering AMT, and then holding those until the 12-month clock. There's a 12-month clock. We're not going to get into the weeds on all the tax implications here, and this is definitely something I would not recommend trying to figure out on your own, because it's really easy to get it wrong.
Even the reporting on the tax return is easy to get wrong. So
yeah. And I've met plenty of CPAs who don't get it right either. So
yeah.
not Deva, but it's just really tricky. So, but if you have incentive stock options, if you're thinking about exercising some, this can be a really great time of year to do it, because it's just really easy for us to calculate exactly how many you can exercise. Any questions on that? Again, I know Deva could talk about this all day. I don't think I could talk about it all day, but all right. Okay. There's a lot on this slide, so we're gonna take our time here. I think I'd love it if you want to talk about wash sale rules, Deva.
Yeah, I want to talk about wash sales. We got to be cautious of wash sales. So I'm going to start by just defining it for those who might not have heard about this rule. basically, if you sell stock at a loss, which was happening to a lot of people in the last 2 years as the market was down, whether this is like some stock you're holding randomly in your portfolio or your company stock, if you sell it at a loss, the loss might be disallowed because of this wash sale rule on your tax return. It's not going to go away forever. It's outside of the scope of today's conversation to like how and when you get to get that loss back later. But if you are purchasing or acquiring that same stock within 30 days of that sale at a loss, it's going to be disallowed. And this includes RSUs and ESPPs. So it's happening by accident to a lot of our clients. So you might sell some company stock at a loss. You want to diversify. And then boom, 2 weeks later, RSUs vest. Or 2 weeks before the loss, you had some ESPP purchases that were predetermined, preset dates. This can be really painful for people who sold some stock at a gain and they thought they were offsetting it by selling company stock at a loss, and they thought there was gonna be no tax there, like she was talking earlier about tax loss harvesting, and then boom, the losses are disallowed on your tax return. So it happened to a lot of my clients last year, and there is a workaround. You want to work with a professional, but if those new shares that vested or that you purchased, if you sell those by the end of the year as well, it eliminates the problem. It kind of makes it as if you never bought the new problem shares. So it's a complicated rule, complicated tracking. The brokerages are doing a bad job of tracking the basis. This is something someone asked a question before the webinar about what to be tracking. You want to be tracking your basis in these shares and having some help.
Yeah, I think that we'll definitely touch on that question in particular, because I think that was a great one, just kind of what to track and how to stay on top of stuff. But this one is definitely an easy one to kind of screw up or forget, or you get the timing wrong.
And like, just so it makes more sense, like a lot of this law came about because the IRS didn't want people to be able to sell a bunch of stock at a loss, take advantage of the tax savings, and then just repurchase the same exact stock the next day or the next week. So that's why it was developed, but then we're bumping into it with the RSUs and stuff.
Yeah, it gets especially tricky if you work at like Google or something where their shares vest once a month. It's
monthly.
Like,
you like literally can't dodge it, but the only way you can dodge it is if you just auto sell all your shares and sell them by year end. Yeah.
Right, exactly. So one thing I wanted to call out, because I don't think it's on most people's radar, is the current tax law, which is called the Tax Cuts and Jobs Act. I always have a hard time saying it. TCJA is set to sunset at the end of 2025. So what that means is the way that it's written today, which of course could change, but the way that's written today, at the end of 2025, we're going to go back to the old tax brackets, the old standard deduction limits, all that kind of stuff is going to go back to what it was in 2018, I think is the year. So for most people, your tax bracket is set to go up quite a bit because they all came down with TCJA. So I just wanted to call that out because, again, these next couple of years might end up being relatively low tax years. And then we might see all of the tax brackets go up across the board in 2020 at the end of 2025. Now, there's a huge caveat to this that another tax law could be passed before the end of 2025, and we could be in a whole new tax landscape. So nobody really knows how that's going to play out. But for our purposes for today, what we do know is the way that the law is written right now, which is that, again, in 2 more years, we're kind of going to revert back to the law the way it was written before TCJA. So, and I have the tax brackets here. I'm not sure if I'll end up showing them, but I kind of have a slide that shows just what they were previously and then what they changed to. So for reference, because most of us have forgotten what it looked like 5 years ago. But I just want that to be on your radar.
For like planning purposes, Danica, are you like, if people have like a big income event they can trigger in the next few years, is that the sort of thing that you might want to consider? Or and then just kind of like a big heads up.
Potentially. I mean, I'm not saying we want to accelerate income like
yeah,
real significantly, but it might mean accelerating income into the next couple of tax years. Like I was talking about somebody who has an inherited IRA that they need to distribute sometime in the next 10 years. probably want to do it sooner rather than later, or spread it out. But if you were going to take it in a single year, you wouldn't want to wait until 2026 because the profits are probably going to be higher. That's my guess anyway. You want to talk about SEP IRAs?
Yeah, I love SEP IRAs. So if you're self-employed, or even if you just have a little side hustle, some kind of side income, if you have a profit on that self-employment income after you take expenses, you can fund a SEP IRA in addition to like your company 401k that if you work for an employer as well. The limit to how much you can fund, we're not showing here because it's a calculation that changes based on the profit of your business that year. So you usually want to wait till you file your taxes to make this contribution. And like we would test for the maximum you'd be allowed to fund. And you can do it all the way till April retroactively for the prior year. So, but I do tell people if they want to be setting aside as they go, it'll roughly come out to 20% of your business profit that you'll be able to put into the IRA, and then you get to save tax in your top tax bracket.
Mm-hmm. Yeah, awesome. So yeah, usually people do wait until the end of the tax year because it's directly how much you can save is directly related to your business income, and so people won't necessarily know that until the end of the tax year. But yeah, if you have consulting income, any kind of side hustle, that's a great way to get some more money put away in a tax deferred account.
And that, yeah, you don't only save tax this year, you're putting aside more for the future. So.
So one of the things that's come up a lot in the last few years, and it depends on the states that we're talking about, because some states are more aggressive about this than others. But if you have moved and you get RSUs, you get some other form of equity, and it's vesting over a period of time, you want to be really, really careful and cautious about sort of tracking and making sure that your company is aware of the move and is also reporting it correctly. So this gets really, really sticky. I saw it earlier this year with the Stripe tender offer that happened. There was all sorts of, I had clients with like multiple different states happening over, the course of their time at Stripe, and Stripe was sort of calculating, when they lived in which states and how much tax was taken out for each jurisdiction. And if the client doesn't keep records, it's really hard to verify whether or not they're doing it accurately. So I would be really attentive to this. So if you do move, my top recommendation is like switch everything over as soon as you possibly can. So change your voter registration, change your driver's license, change your, whatever, everything that you can, potentially even keep like plane tickets and stuff like that, so you can document when you were in different locations. And then, I don't know, keep some sort of record, spreadsheet, something like that of those big moves. I don't know. The other thing that I don't see quite as much of this, Deva, I don't know if you do, but what about people that are sort of like working remotely for extended periods of time in like a different
states have different rules, for sure. But like, most of our people are Washington, Oregon, California. California is aggressive. Oregon's the same way, actually. Like if you're working a certain amount of days in that state, they want you to pay tax on it. So if you're telling your tax advisor how many days you were in that state, whether or not your employer knew it, you're supposed to owe tax there. So, and then with the RSUs, like Danica was saying, it's super inconsistent which employers have been doing this reporting correctly. So like we do the allocation for all of our clients. Every single grant you have, every single vest is going to have a different percentage. Like let's say you move from California to Washington. The longer you're in Washington, each vest is slightly less taxable in California. And, so like a couple of just very large companies were just getting it wrong. So if you're hiring a tax pro, I would say like, are you comfortable doing a state allocation on my RSUs and, overriding this incorrect W-2? Because you're just going to get a W-2 that shows how much is taxable in each state, and it might be wrong.
So if that happens, do you try to get an amended W-2, or you just submit the documentation that says this is our own?
Yeah, we just file it as it should be. And then if we hear back from the state, we have all of our records, and we do hear back from California sometimes. But it's yeah, it's been, I don't know, 50-50 or even worse on how many companies are doing that reporting incorrectly.
That
Yeah.
drives me bananas, but doesn't surprise me. I would say most reporting is unreliable across the board. So you know, with the exception, I mean, W-2s usually seem to be right, but this would be a case where they're not. But custodian paperwork, 1099s and stuff like that, I think are consistently, I don't think they're very reliable. So you wanted to talk about energy credits and electric vehicle stuff. I kind of
Yeah.
left this one line just for
Yeah.
speed.
Yeah. I mean, I've taken like a 8-hour class on the residential energy credits and that, so but I'll just say that the old credit max was $500 lifetime, and a lot of people had already surpassed that when they, put some new windows in their house and they got a $500 credit one time. The new credit is $1,200 a year max for things like windows, doors, insulation. There's a whole long list. So if you're starting a home project and doing some energy improvements, if you can spread it a little over 2 tax years, you'll get an extra $1,200 in tax credits if you have some costs in over 2 years. Same thing. There's another big one that a lot of people are doing here in Seattle, maybe getting AC for the first time, getting a little heat pump mini split thing. Those are $2,000 tax credit. And a lot of times they only fill up like 1 or 2 rooms in your house. So you might put one in your upstairs and one in your living room. And if you call someone and get one installed in December this year, $2,000 tax credit, do another one next summer. So spreading that out as a strategy, not huge dollars, but it's free money to grab. And then the electric vehicle, I just wanted to point to let people know that their income is likely too high to get this credit now. So you might have heard of the $7,500 electric vehicle credit. But if your income's over 150,000, if you're single, or 300,000 if you're married, you're gonna phase out of getting that credit. So just setting expectations on that one. There's a lot of other rules too, about the vehicle and how it's the battery type and all this stuff.
So the expanded residential energy credits, does that include solar, or is solar at its own rules?
Solar's still at 30%, so you're gonna get just like 30%. So if you spend, $30,000, you're gonna get a little less than $10,000
Okay.
credit. So that's still pretty great.
Yeah. Okay. Awesome. Okay, that was a lot. Whew. Any questions on anything on this slide? I think that's the last one, actually. So I'm just gonna kind of put this up here for a second while we maybe talk about some questions. I just thought it would be helpful maybe for people to see what the old tax brackets were and then what that change was with the Tax Cuts and Jobs Act. So on the left, you can just kind of see it only shows single and married filing jointly, but it still give you a pretty good frame of reference for what the brackets were. And then the top bracket was 39.6, and that kicked in at about 480,000 for a married couple. The one on the right is what the Tax Cuts and Jobs Act was in 2018. So it's 5 years old. So, I mean, it's inflated since then, but you can see, we don't even kick into the top tax bracket of 37% until 600,000. So it's quite a bit higher where those thresholds are. And then of course they've increased. So just wanted to throw that out there for reference in terms of thinking about how, again, as the law is written today, how we could expect tax brackets to change when this law
yeah, it's significant. And now in 2023, the top bracket 37% doesn't start till the high 600s for a married couple.
High 600s or even low 700s. Yeah, it's quite a bit higher. Okay, so we got some questions ahead of time, which I think we'll try and cover in the next 15 minutes. If you have additional questions that you want to drop in the chat, I don't think I've seen any come through, but if you have additional questions, feel free to post them. And if we don't get to your question and you want to email us, you're welcome to do that too. But I think the one I would love to talk about first is that one, Deva, which you already touched on, which is like what should people be keeping track of and how, like, what information should people keep, I guess, with regards, I mean, taxes in general, but I think specifically around their equity, like what's important and how should people sort of manage and organize this stuff?
Yeah, I mean, we were talking about this the other day and kind of laughing. It's like, keep everything. I mean, it's nice that we don't have to keep paper files anymore, right? We all have a way to store things digitally. So just keeping track of everything. Basis in your shares in equity compensation, whether they're RSUs or stock options.
Hmm.
Just doing basis tracking is the most important thing, or having your advisor do it for you, because we're just seeing 1099s with incorrect basis left and right, or we're having to track wash sales and the basis in the new shares, or complicated things like that.
Mhm.
But yeah,
Yeah.
I don't know if there was other points to that question to answer.
Well, one of the things that I mean, I think you and I have slightly different frameworks for this because we're dealing with slightly different, aspects of how this shows up for our clients. But I personally would keep some kind of folder with every single thing that you ever get.
Oh, grant documents and stuff too.
So
Yeah.
for me, like what I really care, I want to see a stock plan agreement, right? Which is generic, like that's for the whole company. It's not going to be specific to you. But if you have the stock plan agreement, I would keep a copy of that. If you have the original grant documents, keep that. Like everything that you ever get, I'd put in the same folder. And then in terms of like, having a spreadsheet or something like that, I would definitely keep track of sales, right? So in terms of like wash sales, like you want to know, hey, I sold, 50 shares on June 1st. You want to know when your vest dates are relative to that. And so I would keep track of any sales, any exercises that you do of stock options, all that kind of stuff. And so really basis is the most important thing, or cost basis, as Deva said. But I would literally keep everything. And ideally in one location. So if you have like a single folder where you keep all of your company stock related stuff, that to me is ideal. And then kind of just more generally, like for tax related stuff, I also have, a folder where every time I make a charitable contribution, I drop the receipt in the folder, right? So if you have a system like that, it can just really save you from having to scramble in February to try and track down all of the charitable contributions you made, or all of the business expenses you had, or whatever those things might be. So some kind of, just consistent location really is the primary thing I would focus on there. Anything else you want to add about like what to keep track of or where to keep it? What helps you? What's your ideal client do?
Yeah. I mean, we have their back, right? Like we're gathering like the stock plan agreement and the grant docs when we onboard them as well. So that's helpful for our clients to know that they have that going on. But yeah, just like she said, I mean, when the RSUs come in, there's a statement of release that shows the best, those are in your brokerage account when you log in. So I don't know if you actually advise like printing them out and saving them all, Danica, or if you just kind of trust what's going on there.
I don't know anybody.
Yeah. So I think, yeah. And then a lot of our clients are dabbling in crypto. It might not be huge dollar amounts, but the reporting there can be really inconsistent. So having your own spreadsheet when you're doing transactions with crypto, as well. And then if you have like a rental property or a side business or anything, I'm always trying to get people to have actually a separate bank account for that, so that it's easier for them to track if they aren't like on it all year.
Mm-hmm. Mm-hmm. So I'm trying to remember what some of the other questions. I see one in the chat. I want to think about the ones that came in ahead of time as well. There was one earlier today. Somebody asked something about putting contributing stock directly to a 529 account. And as far as I know, you can't do that. I've never
Yeah.
heard of it before.
No, you can't. I mean, the question too said, what's the benefit of a 529 plant account in general? So, a college savings account for your kid, and you're
Mhm.
not getting an immediate federal tax savings when you contribute. Some states do give you some savings,
Mhm.
but basically you're funding money for your child's education, and it's going to grow tax free, and you're not going to pay tax on the growth if you use it for education. So the earlier you can fund those accounts, the more compounding and tax-free growth you have. It's like the average person starts their kids 529 plan when their kid's like 9 and only has 1 decade instead of 2 decades of growth. So just starting it early, and it's a little less scary actually starting next year in 2024. People that don't know, is my kid going to go to school? How much should I actually put in here? I don't really know. It's very overwhelming for people to decide. They're making up a cool allowance to roll over a 529 into a Roth IRA up to $35,000. So if you're just like wanting to get started with a 529 until you have more than that, you could actually roll it into a Roth, which is cool.
Yeah. 529s are, probably that's as much as we maybe need to cover for right now. There's definitely some other sort of pros and cons and considerations there, but you don't really get a tax benefit by contributing to one. Occasionally some of the states you might get one, but yeah, from federal level, there's really no tax benefit, but you are getting tax deferred growth. And so that's really the power of a 529.
Another question that came in ahead of time was from someone in the video game industry asking if they could purchase video games and write them off, or should I not even try to argue for that? And so this question, I'll answer it not specific to this person, but just if you are an employee and you have an employer, nothing that you're buying that's related to your industry is going to be deductible for you. But if you're self-employed, or if you even have some self-employment income, then these purchases are definitely deductible. You might want to consider allocating a certain percentage to personal use. So for this person, if they had some income from the video game world, 1099 income, and they spent $10,000 on new games that year, they might want to say, well, maybe 2/3 of that was work related and 1/3 was personal. If you did write off the whole thing, and this could be for anyone in any industry buying a related expense, and you were audited and the IRS whacked it back and said, no, we're only going to allow this much, you would just owe interest and tax on the amount they whacked back. You wouldn't be in trouble if you had good reporting and good reason for arguing that this was a deduction. So.
Okay. So one of the questions that just came in, are there recommendations for couples that got married this year to minimize any tax burden next year, didn't make any changes to withholdings, and don't have a good idea of possible shortfalls? I mean, I'll say something quickly and then you can chime in, Deva, but I think it really depends on your relative incomes, right? And your own tax situation. So sometimes, if there's a huge income differential, that can really hurt the person that's maybe been in a lower tax bracket now being brought up to 32 or 35% tax bracket. So there could be a significant shortfall. Whereas if you're both already, you've both already, in a higher income tax bracket, it might not have as big of a difference. So it really kind of depends on like what your prior tax situations were. But Deva, what are your thoughts?
Yeah, so if you are both high earners, it can be called like the marriage penalty, where you're both already high earners and now your more and more income is hitting these very high brackets. And so you probably are going to want to adjust withholding. You could do that as soon as right now. Like you could pretty easily sketch out with a pro what's your average tax rate going to be, and look at what your withholding rates are and increase it now, at least for the last few paychecks, and it'll be set in good place for next year. But in some cases, if we have a really high earner and they marry into someone who's not making much or not working at all, that actually really helps out because their income as a single filer was hitting higher brackets. And so it's going to depend, Ryan, whether or not like what your guys' situation there is, but making some increases right now or an estimated payment would be helpful.
Han asked about using a jumbo Roth instead of a 529. Han, what's a jumbo Roth? I'm not sure what a jumbo Roth is, but I can speak to Roth versus 529. So I have definitely seen people use Roth IRAs as a vehicle for college savings. I don't think it's ideal, but I also don't think it's a terrible idea. So if you do put money into a Roth, you can always take, there's a 5-year clock. So, you have to wait 5 years, but once the 5 years has elapsed, you can take your contributions out without any kind of penalty. So even if you're not 59 and a half, but you put $20,000 in, you can take that $20,000 out without without penalty. And if you're over 59 and a half, then of course, it's totally fair game. So I have seen people use Roth IRAs for college funding. Again, I don't know that it's necessarily something I would recommend, but it can work. And Roth it's so nice to have money in Roth in general.
For your own retirement. Yeah.
Yeah, for your own retirement. And then, in terms of flexibility, it's like, well, whatever you don't spend on college, you've still got left for your own retirement. So it's a little bit more flexible in that sense. But yeah, I don't know if I got the question right. But that would be my thoughts. Did you have
Yeah, I
any?
mean, it is specific looking at how many kids you have, how much percentage of the total cost of college are you trying to cover here? And so a lot of times people are putting some in a 529, maybe they'll use some of Roth and some use cap, and some portion of each. Especially just not knowing what the spending, what the cost is going to increase to by the time your kid's in college. But there is a way to super fund a 529 plan also. So you can do 5 years of the annual gifting limit at once. Do a little Googling on that, or talk to a pro, and that's a way to get in a bunch of money when your kid's young and really benefit from the compounding.
Yeah, super funding is a great option. So yeah, super funding a 529, you can get 5 years worth of contributions, or 5 years worth of the gift exclusion in at once. And then especially if your kid is like under 5, that can be really powerful. So I've seen people kind of put $50,000 or $100,000 in when their kid is a baby and never add anything again. And then it grows pretty dramatically by the time they get to college. Tiffany asked a great question, which I'm sure you would love to answer, Deva. If
I
you have
would
AMT
love to.
credits rolling into this tax year from previous tax years, can I apply those credits to my regular W-2 income, or can I only apply that to AMT?
Yeah, so I don't know, Tiffany, if you are now doing more exercising and creating more AMT. In general, when you have an AMT credit, which means you paid AMT in the past, if you have like no activity with incentive stock options this year, some of that credit is going to pop out and help pay some of your tax. So like, I think what you mean in this example is like, let's say your W-2 income, you were a little bit under withheld. Let's say you were under withheld by $5,000. Well, if $5,000 of your AMT credit pops out to cover that, you're fine. So those two things can interact. Is that how you interpreted the question?
I think so. That's my read on it as well.
Yeah. So yeah, okay, cool. So you don't have to create more AMT for that to help out. No. And in fact, if you create more AMT, it's going to be such that none of the credit's going to pop out in that year.
Okay.
It would come later.
Okay. There was another question that came in ahead of time about TIPS, which are Treasury inflation protected securities, not tips that you get if you work in a restaurant.
We're assuming that he meant
I think so, because they were capitalized. But it's a type of investment, basically, how those are taxed, and then kind of like tax efficient ways to keep cash, I think was the other part of that question.
Yeah, I mean, everyone wants to know that about how with their cash or what to do. But the tips one, those are taxed like interest, so they are going to be taxed at your top tax rate. So as the interest is paid out on those, the year that you receive the interest, it's taxable. You get a 1099 INT, and then you also get a 1099 OID, that's original issue discount, and that's like inflation based. The tips are going to go up in value. I'm forgetting the word, but the value of them is going up due to inflation, and then you have to pay tax that's also taxable like interest.
Okay. Yeah. As for tax efficient ways to keep savings, I mean, I don't know if there's a really good way to answer that. I mean, up until a year or two ago, like we were all getting, 0.05% interest on our savings accounts anyway. So there wasn't really much of that happening. And now that we're kind of in this really high interest environment, it's great because we're all getting much higher interest on our emergency savings and all that stuff. But I'm not sure that there's really a way to shelter that from taxes that I'm aware of. If we're talking about something that's FDIC insured, which would be checking and savings accounts and CDs, which are insured, there isn't, as far as I know, there isn't a way to shelter the interest from those. And realistically, the interest rates aren't going to stay this high for very long. So, we'll probably be back in the 0.05% before long, and then
Yeah.
more of a moot point.
Just have fun with the high yield savings accounts while you can and pay a little bit of tax on it. Yeah.
Enjoy it while it lasts and pay a little tax. Yeah, that's kind of my answer.
There's some tricky strategies for offsetting capital gains tax. That would be a whole nother conversation, not the question at all, but but yeah, with interest, I don't nothing comes to mind.
Unless you kept in some sort of, if you kept it in a Roth IRA, but why would you do that? Yeah. Anyway, I hope we answered that question. I think we're right past 5. So
it got dark. I need to turn on some lights.
I know.
Yeah.
If there's a last question, feel free to drop it in the chat. Otherwise, we will be sending out the recording for this. We'll also post it on our YouTube channel. So, feel free to watch it multiple times or share it with somebody if they couldn't come. And our contact info is, I don't know, I guess it'll be in the follow-up. Feel free to check out our website if you haven't already been there, if you're not already a client, if you're interested in finding out more about what we do. And thanks so much for coming. It makes me so happy that so many people came to listen to us talk about taxes.
Yeah, totally. Thanks, everyone. Nice to meet you.
Bye.